Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Tariff news coming out of Washington, D.C. President Trump raising the tariff on Canadian steel and aluminum from our good friends, I like to think, still in Canada. And that is certainly rolling in the markets. S&P is off 0.6%. The Nasdaq's off 0.25%. We're going to break it down with a couple of experts over the next couple of segments. Let's go right to Joe Deaux. He covers all the metals and mining for Bloomberg News. Joe, how much aluminum do we get from Canada? I know it's a big deal for them. Right. Is it a big deal for us as consumers?
Yeah, it's massive. Okay. One of the numbers that we ran out, and Richard can probably get this a little closer, but it's something around 70% of the aluminum consumed in the United States per year is produced in Canada.
Oh, boy. Oh, boy. All right. So what's the feeling here within the industry about what's happening, how the industry might react?
I think at this point, there's quite a bit of confusion within industry. I mean, we don't know for sure, but it's not clear that the President of the United States had at least telegraphed that he might be going to double the aluminum and steel tariffs. So you're probably having a lot of chatter around boardrooms at places like Ford and Molson Coors and Budweiser and Coca-Cola.
Oh, boy, I want to bring in Richard Bourke. He covers the metals and mining stocks for Bloomberg Intelligence. Richard, give us a number on kind of how material this is in terms of how much aluminum do we, in fact, steel, all that stuff, do we get from Canada?
Okay, so Canada is the number one exporter of aluminum, as Joe mentioned. They're also the number one exporter of steel to the U.S. Aluminum, it's a much bigger problem because the U.S. doesn't have the capability to produce aluminum because our electricity is number one cost to produce aluminum. We're not competitive on electrical energy costs, so therefore we need to import aluminum. On steel, on the other hand, the U.S. imports about 20% of its steel needs. Our analysis shows that maybe a third of that is steel that the U.S. producers don't want to produce or maybe can't produce. So therefore, with the current industry utilization at around 75%, they can ramp up and cover any shortfall, on steel. Aluminum, we don't have that capability.
Ryan Grabrinsky of Strategas said, another day, another tariff announcement. How seriously should we take this? I mean, markets are reacting as we've seen the whiplash the past weeks. But when do we know if it's the, quote, real deal?
Well, that's the $24 question that everybody's asking. This one sounds like it was in response to Canada coming with a 25% energy tariff. So I could see it, if Canada rolls back their tariff, the U.S. rolls back, maybe back down to 25%.
Hey, Joe, so you mentioned kind of the people that actually use aluminum, whether it's making a can for beer or soda. Are we hearing anything from just those types of people? Because those are the ones that are going to have to deal with as well.
Yeah, I mean, the packaging companies in particular are a little more careful because there's a lot more competition there. Like the first time around, I remember hearing from one of the big beer companies saying, Joe, if we raise the price of, a 12-pack or a 6-pack of beers, the other company would come in and eat our lunch for it, right? However, I was saying earlier with Richard on another segment, the Ford CEO came out a month ago and said these tariffs will blow a hole through the industry. So I think you are starting to hear more CEOs actually be a bit more aggressive with what they're saying. Now, partly that is because of the bigger concerns that go beyond just metal tariffs. Mexico and Canada tariffs would be absolutely difficult to handle. But yeah, I think you're hearing it from them.
Rich, 30 seconds. What if any of the companies reacted yet so far today?
We haven't, Alcoa on their latest call had kind of outlined a scenario what they saw would happen. And what they saw happen is they would shift their production to Europe or shift their shipments to Europe, and they expect a lower tariff country
Yep.
to come in and backfill what they didn't do to the U.S.
Okay. All right. Appreciate getting both of you guys. Joe Deaux covers metals and mining for Bloomberg News. Richard Bourke covers it from Bloomberg Intelligence side, looking at the companies here. So again, the news, President Trump doubling the tariff on Canadian steel and aluminum to 50%. A bigger issue for aluminum is what we're learning here.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's head down to Houston right now. Bloomberg Intelligence co-host Alix Steele speaks with Carlyle Chief Strategy Officer of Energy Pathways, Jeff Currie. Let's go to Alix right now.
Hey, Paul, thanks a lot. Really appreciate it. Jeff, I've been asking CEOs for the last day and a half, what do you do with 25% tariffs? And now it's going to be, what do you do with 50% tariffs? What's going to happen to the market?
Well, it's pricing it in. Copper is, is heading towards $5 a pound right now. But I think aluminum is the one to really watch because the question is, can you onshore aluminum production? And the answer is absolutely not. If you think data centers and AI are power intensive, aluminum smelting is in a whole different world. It's 6 times more power intensive per dollar revenue than AI data centers. So if you're already power constrained, there's no possible way you're going to bring all of this aluminum smelting into the United States. So
where do we get most of our aluminum and steel then, the refined products?
Well, a lot of it comes from the hydroelectric power up in Quebec. So it comes down into the U.S. from that. So shutting down that cheap source of aluminum supply and trying to replace it with really expensive domestically produced supply, I think is going to be a tall order to ask.
It's been a tough commodity road in the last couple of weeks that we deal with this volatility, right? Oil was at a 6-month low. That's on recession fears, tariff fears, growth fears, etc. What kind of cycle are we in right now?
Well, I think what we're going through is a huge shift in the global order around security. And I think, what is the response that probably Ontario is going to do to these tariffs? They're probably going to cut power. The governor's already threatened he's going to do it. He cuts power into the U.S. Energy security is top of mind. And I think that's what's going on right now, whether it's in Germany. Actually, Germany, the Norwegians threatened to cut power into Germany back in December when a crisis occurred there. So I think energy security is top of mind for everybody around the world right now.
Okay, so what does that look like? Because what's so interesting about commodities is it'll always clear at a price, right? You'll always buy something. It just depends on what price you'll buy it. Is that still true?
Absolutely. And I think what we're going to start to see is that's what's going on with aluminum and copper today is they're going to price in a security premium to make sure you have that supply in your country, domestically protected and duty paid. You're seeing it in gold and you're seeing it across the metal space. And in particularly in energy, we're beginning to see that. And I think that is going to be the primary driver of the, let's call it the news cycle in commodities.
So it's not geopolitical risk. It's not a green premium. It's a security premium.
Correct.
You're going to pay up to produce this stuff at home.
Yep, exactly.
That's a humongous shift.
Oh, it's huge.
Huge.
And it's going to be really difficult to do, whether or not, and I think the argument we take is it's going to be a diversified set of energies. That's why we call it the new dual order, is because you're going to want oil and gas, you're going to want renewables, nuclear, you're going to want everything, and you want to diversify yourself, because if you lose one of those supplies, you want to be diversified so that you can deal with that disruption. And I think the key point here is when we think about fossil fuels, why do we like fossil fuels so much? Is because they're tradable. They're portable, they're storeable, and they have high energy density, which is why we move them around the world. Those same reasons we like them is the same reasons they're so dangerous, because somebody can just take them from you. And so when we think about what's driving, I think, this new environment we're living in, let's call it peak trade instead of, peak. Actually, look at the evolution of peak oil. It started out peak supply, we're going to run out of supply, and then peak demand, we got too much of the stuff, so we need to reduce the emissions, and now it's peak trade, meaning I can't get my hands on it.
So what's going to be really interesting then is if we get a peace in the Ukraine war, what happens with Germany and Europe in buying Russian gas?
They're going to be hesitant. They'll probably
They're
take a little bit. Yeah, they're still buying it, but they're going to diversify their sources. And I think that's the key message here, is diversify your sources so you're not so dependent on one supplier, one type of energy. And I like to point out, What is the best-selling car out there? A PHEV, a plug-in hybrid. Why? Because it operates off oil, gas, solar, wind, nuclear, the entire gambit of all the energy sources. And I think that that type of diversity is going to be key in this new dual order.
Okay, so if I'm looking at prices in general, like does the band move up? Do prices become more volatile? Do they move down? Like if I'm looking at, say, oil or copper, what's my trading band?
I think that the volatility is going to explode across all these markets. You're already seeing it in power and the metals and across the space. That's going to lead to a higher average price. By the way, the volatility then discourages the investment. People go, I don't want to invest in this thing, it's too volatile. Lower investment creates more volatility and it just feeds off of itself.
You're one of the first to invent the word supercycle. Right? That we have big super cycles, there's big ups, there's big downs, and there's an investment cycle that goes with it. Are we no longer in that?
You know, I think that's a great question. And those super cycles before were created by demand pull, creating big shortages, created these big trends that created that super cycle. This one's a malinvestment cycle. It's industrial policy push, which creates pockets of imbalances. I like to call it, it's like a bubbling cauldron of little mini super cycles everywhere, and you get these high volatility, and that's what we're seeing. By the way, the opportunity for investors in this environment is phenomenal. In fact, one of the themes going around here in CERAWEEK is the oil market and these markets are micro bullish but macro bearish. So that micro creates these little opportunities inside there that you can take advantage of, but you don't get that big upward trend. And I think this bubbling cauldron of little supply and demand imbalance is probably the best way to describe it.
Does it change the time horizon for investments or the return for those investments?
When we think about long-term investments, it's going to provide a very similar return, but you got to manage that risk. And I think that's the real the message here. When we think about, the focus before was on levelized cost of energy, get the LCOE down. We got it down, but we were unable to deliver the joules. So you think about Germany, it got its levelized cost down, but it could only produce the power when the wind blew or the sun shined. Now the focus is on that delivered joule. You can think about now the focus is on ROE instead of LCOE. And so again, another way to say it is dispatched power that goes to the consumer as opposed to a centralized production of power.
Okay, fascinating. One more quick question, because you're and it's an oil conference.
Yeah.
What's the lowest price of oil you think we're going to see this year, and what's the highest?
Totally
unfair question.
But I think that's a great question because about this drill, baby, drill.
Yeah.
We're sitting on the bottom of the cost structure right now. You already see it, drilling's coming off. All the OPEC countries are under pressure. Yeah, maybe you can get down into the low 60s or something like that. I would argue, the market's to the upside. Looking at the amount of investment out there, inventories are low. By the way, and now you put the security premium, people are going to be scrambling to get the barrels, bring it in, and I think that's going to be the key message.
Jeff, always a pleasure.
Great.
Love chatting with you. It's always
Excellent.
good to catch up with you at CERA as well. Jeff Currie, Carlyle Chief Strategy Officer of Energy Pathways. Paul, back to you.
All right, Alix, thank you so much. We appreciate that. Bloomberg Intelligence co-host Alix Deaux speaking with Carlyle Chief Strategy Officer of Energy Pathways, Jeff Currie.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's head down to Houston, Texas, H-Town, as they say. Bloomberg Intelligence co-host Alix Deaux speaks with Speaks with TotalEnergies CEO Patrick Pouyanné about the French oil company. Let's go to Alix right now. Alix.
All right, thanks so much, Paul. I appreciate it. Right, I'm here with Patrick Pouyanné. He's chairman and CEO of TotalEnergies. And the amazing thing about Total, it's a European energy company, but it uses its money from oil and gas to do stuff in power and alternative energy. That's a model that not a lot of other companies actually subscribe by. So it's great to get your perspective. Patrick, thank you so much for joining me.
Thank you for welcoming me.
News of the day. We just heard that we have an emergency electricity issue in the United States. President Trump is now declaring 50% tariffs on steel and aluminum imports from Canada. Your reaction to a trade war?
I think it's not. I think this war should. I hope it will end quickly. I think it's better not to have wars, to be honest. Maybe it's a tactic to negotiate. And I think honestly, all these economies are interconnected. In fact, in North America, in many ways, the cars, parts, etc., including, by the way, electricity. You know, of course, the northeast of the US are receiving electricity from the hydro of Canada for the benefit of the citizens. So there are a lot of issues. I understand also about drugs, migrations. It's not only about trade. So my view is that as a global company, it's better to, I hope this will be solved quickly. That's all what I can hope, in the benefit of all the parties. And like it was for Trump 1, I remember there was a debate at the end. Maybe the shortest would be the better for everybody, including, by the way, for the US economy.
So does it make you think 2 or 3 times about investing in the United States?
No.
Why not?
No, because I'm an energy company. Energy, it's a nice country for energy. You have the cheapest gas, you have oil, we can explore, we can develop. In electricity, a booming market of electricity, you need more electricity.
It's going to cost more now, no?
Yeah, but it's good too. We can build gas plants, cheap gas-fired power plants. We are building also in Texas. We are in Texas today. I have 5 gigawatts of solar plants. It was easy to build here because you have a lot of space. Combining plants with renewables with gas plants is a nice way to produce more electricity. So for me, the US is a large market, and we are ready to invest in the US. I understand that the only point is that if we need to reshore, for example, all the solar panels that we use on our renewable fields, why not? It's just a little more expensive, so the customers will have to pay somewhere.
So not you, but the end market.
Yeah.
Okay, but then let's just tackle, say, offshore wind for a second in the
Offshore
US.
wind, I put it on a pause.
A pause or like the garbage pile?
No, not garbage, pause. We got a concession for 50 years.
Okay.
So I understand during these next 4 years, no way to obtain any federal license. So I don't want to spend my time to lose my time. My teams, I don't need to spend money for that. So we say no, we put a pause. We have reduced our teams to minimum. And then 4 years, we'll see if federal government policies are changed.
Are you worried about any existing leases that you currently have and operating for wind and solar? I was talking to the Secretary of the Interior who didn't rule that out yesterday.
No, to do what?
To take away those leases.
To take away the leases,
Yes.
but the leases, you can manage that on federal land, so I check. I have no leases on federal lands. And by the way, in Texas, there is no federal lands almost, so we make our due diligence, so we are fine.
Okay.
And I think, honestly, when I discuss, by the way, Elon Musk is a big fan of solar and batteries for good reasons. So I think, and we will see the debate, I'm sure the debate at the Congress and the Senate will be interested with the reconciliation bill. So that's clear, but for the time being, we'll wait to see what are the new fiscal conditions to develop solar in the US. But there are a lot of red states where we develop renewables. And again, what the priority for President Trump administration is, we want more electricity for AI, for data centers. It's all of the above, more electricity. It's gas, it could be nuclear, but it could be also renewables with batteries. So I'm optimistic.
Okay.
I think at the end, common sense in US, what I've observed, at the end, business interests are always respected. And you have fundamentally, the Trump administration is very business friendly. So why not for energy, which is at the core of all their program for growth?
Okay.
So I'm optimistic.
Globally, though, I mean, we're looking at stocks taking a hit. The sentiment's not great. There are worries about recession either in the U.S. or elsewhere because of tariffs. Are you seeing any indication of that?
Yeah, but because you know what people hate? It's uncertainty. What has been created is uncertainty with all these tariff wars. So suddenly we don't like the markets, the stock markets do not like. We don't know where we go. So putting the chaos is a nice way to negotiate. I can use it myself from time to time. I'm not a big guy. I'm not sure I'm obtaining the good results, but short chaos, please. That's all. But the markets are saying to the administration, we don't like uncertainty. We are changing the world. Where do we go? So I think the shortest will be the better for all the interests, including fundamentally for the US economy. And I'm sure that President Trump and his administration are very led by the unhealthy US economy, which was not too bad, in fact. So stop this uncertainty. That's, I think, the best thing to do in order to avoid a recession and things which, honestly, the US economy should not get.
Again, though, globally, for China, for example, if China puts a tariff on U.S. LNG, that does directly impact your business. You're a huge gas and LNG trader. So how does
it does not impact?
How
I will
not?
tell you.
Why not? Doesn't it
I will
just
tell you
change
why.
flows?
Because the Chinese are smart. If they choose that product, it's because it has a little impact. Because in fact, a company like Total, we produce LNG, 40 million tons in 12 countries. So yes, my energy from the US will not go to China because there is a tariff, but I will use the energy from Qatar or from Australia to go to China. So in fact, we made the analysis, the impact on China is very minimum, almost nothing. And for you, honestly, today, for us, we are the largest exporter of US energy, more than 10 million tons. Our primary market is more Europe today. So, and we send the Europe, which is fitting, by the way, exactly with the Trump administration policy to expand the business, the trade, or to the trade with Europe through energy, and in particular energy.
What happens though if there's peace in Ukraine and Europe starts buying Russian gas more?
We'll see. First, we need to have peace. Second, we need to see if Europeans will buy more Russian gas.
Any indication that they might from where you sit?
I think, it's not an easy, it will be a debate between economy and geopolitics. Economically, for sure, Russian gas is cheaper, so it was part of the competitiveness of the German industry. Politically, I think it still will be a big debate to see if we take back some gas. Yes, we'll take some Russian gas, but surely not at the same level than before the war. The over-dependency from Europe to Russian gas, I think this era is over. We will be in between. It will not be zero, it will not be 150 BCM per year, maybe half of it, 80. And so that means that still we will need more LNG after the peace than we were using LNG before the war. So for the US LNG, it is a growing market.
And also, you have Germany that's trying to pass money to be able to rearm and reindustrialize.
Yeah.
What kind of demand do you, what's your opportunity set there if that really comes to pass?
But I think Germany is a very strong market for us. We love it because the Germans in electricity have decided to get out, no nuclear, get out of coal. So it will be a mix of gas plants. We need to build 20 gigawatts of gas-fired power plants and renewables. Exactly our strategy. So there is for us, we have invested in the last 2 years strongly in Germany to build what we call our integrated power business. So I think, Germany, and it's true as well, but we need to reindustrialize, we need to produce more weapons in Europe, for sure, in order to be more independent somewhere. And because the message from the US is clear, we need to take ourselves, our future in our hands. So that's good for globally for the economy and the industry.
So what's on your M&A list right now?
My M&A list?
Yeah, are you going to buy something for that? There's a lot of opportunity.
First, we have a huge organic growth. I have 5% in front of me for the next 5 years. Now we have been clear that we want to, in particular, to build a larger gas business, production business in the US. So we made some M&A deals last year. Maybe there is more to come because I need to increase my gas production in the US.
But bolt-ons or bigger deals?
Bolt-ons is fine. It depends. Opportunities. It's a matter of, to make good M&As, it's good to be counter-cyclical. So I will not announce that today at your...
When natural gas
Bloomberg.
Prices are at over $4? Okay, fine. So next time.
So I need to wait.
You have to wait. Okay, I get that. Is this also a good time to get out of certain assets that aren't working for you? Say, is Vaca Muerta maybe on the list?
Yeah, last year one of our peers has done a very good deal. Argentina, we are the strongest gas producer in Argentina. We have also some shale oil. We are not very keen to develop the shale oil for different reasons. And so last year one of our peers has done a very good M&A. So yes, I'm ready to, at the same price than one of our colleagues, I'm ready to divest my shale oil production license in Argentina. That's part of the divestment. But we have been...
Are you getting close to that or not yet?
I don't know. We have processes there.
Oh,
there is a process.
Some news. Okay, all right.
No, this is good news.
All right, let's go to one other area that we want to make some news. So Mozambique LNG, I know you've been working very, very hard on that project to get it restarted. You need reapproval from the U.S. Import-Export Bank for a $4.7 billion loan. How's that going?
I think it's progressing. First, this was approved under Trump 1 administration, so it's a contract which has been signed. I just would like to remember. And I believe in rule of law fundamentally. The contract exists. What happened is that in 21, we had to declare force majeure because there were some security events. We had to stop and so it's just a matter to amend this contract to put a new completion date in 2030 to reflect the fact that between 21 and 24, we are forced to stop. That's what we want, the amendment. So it's not a big amendment. You know the debate. I think now you have a functional US exim. President Trump has decided to put in place a new board, so we'll see, but I'm optimistic that...
Months, years, days, hours?
Months.
Okay, months.
I don't know. No, but fundamentally, I think, honestly, there is no more debate with this administration. The mandate of US Exim is to be neutral in terms of support. In fact, why US Exim is supporting us? Because most of the contracts have been awarded to US companies, US contractors. This project represents 16,000 jobs in the US. That's why US Exim is supporting it. We inherited the project from Anadarko. We are not a US company, but we kept all the US contractors. And that is the driver behind which supports US Exim. It's not TotalEnergies. It's fundamentally the support of US Exim is an export credit supporting the fact that we have awarded more than 40% of the contracts to US contractors, which are all asking me, please restart, because we have the jobs. And they have written to all their congressmen, to all their, this is for what? This is the reason why we can be also pro-US industry when we invest abroad, when we give jobs to US companies. And this is the reason why I think US Exim will honor his word for a simple reason. It's not because it's LNG, it's just because it's US jobs.
Yeah.
That's the fundamental reason.
It's a good pitch. So you're 100% confident that money's going to come your way.
Yeah, I'm 100% confident.
100% confident, okay.
I'm 100% confident.
Patrick, it's a real pleasure. I love speaking with you. Thank you so very much for joining me. I really appreciate it. Patrick Pouyanné, Chairman and CEO of TotalEnergies. Paul, I'll send it back to you.
All right, Alix, thank you so much. We appreciate that. That's Bloomberg Intelligence co-host Alix Deaux speaking with TotalEnergies CEO Patrick Pouyanné on the global oil and gas business down there in Houston, Texas.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Well, yesterday, Toby Rice, CEO of EQT, spoke with Bloomberg Intelligence co-host Alix Deaux about the impact of tariffs on energy investments down at CERAWEEK in Houston. Let's take a listen.
So for our business, surprisingly, from a cost perspective, doesn't have a material impact on our costs, but when you step back and you look at energy as a whole, tariffs on a country like, say, Canada would actually be bullish on natural gas prices here domestically. So that's a big
Why? Because more demand?
Because of the fact that Canada imports so much gas into the United States, which would have tariffs, which would lift the price of natural gas here domestically. But from a minor amount. I mean, if you think about it, gas prices are $4.50. That's the energy equivalent of, call it, $30 a barrel. So I mean, natural gas still is the most cost-effective energy solution, but tariffs are certainly a big theme of the conversations we're hearing this week.
But some oil services say, look, if you're looking at shale and you're going to drill a well, like it could really increase those costs to actually get more oil or get more gas out of the ground. True for you guys?
Absolutely, that definitely is an issue for people that are playing the spot market for their services and looking to gauge their activity levels based on the current commodity price. At EQT, we take a much more long-term steady focus on our activity levels, and because of the fact we've contracted so much of our services, we've insulated the impact of these tariffs, but they are going to be felt by others playing the spot market.
Unleashing American energy is a cornerstone of the Trump administration.
Ooh.
You have been saying that for a very long time.
Yes.
Also. When we talk about unleashing, do you interpret that to mean unleashing oil or unleashing gas?
All of it.
Okay.
Unleash all American energy. I mean, Alix, we are in a place right now in this country where we are producing record amounts of energy. If you added up the oil and the gas that's being produced today, it's over 30 million barrels a day of energy, okay? But here's the challenge. People are scratching their heads at home because Americans have seen their energy bills increase over 35%. How can we live in a world where energy production is up, but prices are still going up? And the answer is quite simply because political force has overwhelmed market forces, and that's made it incredibly difficult for the market forces to work. And that means we see big disconnects between where energy is produced and where it's consumed. I'm selling gas in Appalachia today for $4, and in Boston they're paying $15. There's an incredible opportunity for us to get ourselves out of this. It's not about drill, baby, drill. It's about build, baby, build. And that needs to be the mantra that's going to unleash American energy and unleash energy dominance here in this country, which is going to lower energy bills for American and strengthen our energy security.
And by build, you're basically talking about pipelines. Like the reason why people in Boston are paying $15 is because there's no pipeline that's going to get gas efficiently there. Do you think we're going to get East Coast pipeline? Would you bet money on that?
Well, you know, you look at the headlines last couple weeks, the Trump administration has already thrown support behind the Constitution pipeline, which could bring up to a BCF a day of natural gas. That was one of the travesties that has happened in the past. It was one of the pipelines that was blocked, canceled, or opposed. So for the fact that this administration is putting focus on that, I'm optimistic, but it's not just going to be executive order or political support that's going to make this happen. We need to see real permit reform, in addition to legislative reform, to give our pipeliners the confidence to get these projects built, because the market is screaming.
In 4 years. Got to get built in 4 years. Like that's a tough road.
Yeah, hopefully the legislation reform, the permit reform that takes place will include some litigation reform that will prevent people from actually going back and trying to vacate permits for assets that are already built. I mean, this is the type of situation that's happened in this country. Imagine a pipeline company getting their permits, starting construction, and then having their permits yanked away from them.
Yeah.
Okay? That's exactly what happened with Mountain Valley Pipeline, one of the most controversial pipelines in this country. And that's an asset that EQT owns today. And for people that maybe say, hey, we don't need these pipelines, well, let me tell you what's happened on that pipeline this last winter. That pipeline that people have said is not necessary for this country's energy security had flowed at max capacity, over 2 BCF a day. And here's a shocker.
Yeah.
The price at the tailpipe of that pipeline reached over $35 per MCF. What would have happened if that pipeline was not built? Clearly, there's a sign that we need to get more infrastructure built. And if you think it's hard to get a pipeline built, understand this, it's hard to get a transmission line built, it's hard to get an oil and gas location built, it's hard to get a 5,000 acre solar facility or wind farm. I don't care what type of energy you're building, it's gotten incredibly difficult to get things built in this country. That's why, to get out of this, we need to get back to letting market forces rule and build, baby, build.
Okay, so that's the pitch, I get that. The other side of it is not only to get, say, gas to the East Coast, but also to get our gas out of the U.S. and export it in form of LNG. You're going to need a pipeline from the Haynesville to get to the Gulf Coast. Does it happen?
There is going to be some more opportunities that people are looking at, leveraging existing assets that we have. It's one of the questions that I think a lot of pipeline operators are looking at is the right-of-ways that we've already established. What is the extra capacity that we can put inside those right-of-ways? You know, the environmental disturbance from creating a right-of-way can be muted when you're using existing corridors that have already been created. That can be an opportunity, but the theme isn't just the three themes I look at it when it comes to natural gas. One, continue to evolve our energy systems using natural gas to replace coal. Two is this LNG theme that's taking place. And the third big theme that's taking place is with AI. So there's a really amazing opportunity for natural gas in the future.
But currently you can't benefit off of the LNG export trade right now, right? Because you need your gas to get there.
Well, as America's largest natural gas, America's natural gas champion, EQT, we sell our gas all over the country. And so to the Gulf Coast specifically, we move about 1.3 BCF a day of our product down to the Gulf Coast. About 800 million a day of that is going to the LNG corridor. So we do have access to that market, and we are excited about America's ability to continue to supply LNG to the world and help them lower their global emissions and also provide them energy security at the same time.
You also brought up AI and power demand. How are you guys going to play in that space? What are conversations like? It feels like it's not just independent power players, it's now regulated utilities, it's also energy companies that are now trying to become power companies in essence. What are your convos like?
So AI is the thing that everybody's talking about, whether you're at an energy conference or any conference, people are talking about AI. Just remember, it's only been 12 months since people really started saying this is going to be a big deal. So in less than 12 months, we've seen the momentum for AI only continue to strengthen. How big could this be? There's a lot of wide ranges. Some people are saying 50 gigawatts or 75 gigawatts. People are basically saying between 10 or 15 New York cities, power to feed New York cities. This is a really big deal. We're seeing some technology investors come into EQT that have estimates that we're going to see 175 gigawatts of power demand when you do the buildup on how many chips. So,
but how do you play in that right now?
Well, right now, EQT, about a third of our natural gas in this country is used for power generation. So we've consistently seen year over year higher and higher natural gas utilization to meet power. So when you're talking about AI, you're talking about power, you're talking about natural gas. The evolution that's taken place over the last 12 months, people have questioned, say, well, how will natural gas meet this power demand? Will they play a role? Well, 12 months ago, people were thinking they were going to be able to meet that security or meet that demand with renewables. We've moved past that. Then they looked to nuclear. and realize it's hard to get nuclear built. It's probably going to meet the time ambitions that they have. And so now they've moved to natural gas, which is the most cost-effective, most reliable form of power generation, and most importantly, it's the fastest speed to market. And we think those attributes are going to allow natural gas to take the lion's share of the power gen that's coming.
All right, that was Bloomberg Intelligence co-host Alix Steele speaking with Toby Rice, the CEO of EQT down at CERAWEEK down in Houston. And my takeaway was not so much drill baby drill, but build baby build. So that's kind of a takeaway there. We need more pipelines to get the energy that we do produce to where it needs to be.
It's actually great. I'm learning a lot just watching Alix's interview. I mean, this is a space that's very important and crucial to the economy, but I think doesn't really get a lot of headlines. Not like the S&P.
Yeah, exactly. So the energy business is front and center down there in Houston, Texas. And again, the EQT, they have a lot of oil and gas coming out of their shale areas, but the challenge in some markets is to get it efficiently to where it needs to be, whether it is via pipeline to the East Coast or down to the Gulf for export LNG market. So again, great stuff there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, let's head down to Houston once again. Bloomberg Intelligence co-host Alix Steele speaks with Williams CEO Alan Armstrong. Take it away.
All right, thanks so much, Paul. That's right. I'm here with Alan Armstrong, CEO of Williams. Williams is one of the largest natural gas infrastructure companies in the United States. Great to see you. Thank you for joining me.
Glad to be here. Thank you.
So the news of the last hour is that President Trump is increasing tariffs on steel and aluminum imports from Canada to 50%. What does that do to your business?
Well, we have a number of suppliers, the large diameter pipeline business, a lot of European suppliers, Korean suppliers for that space as well. So, the market will have to react to that. Certainly, though, something that companies will have to react to and respond to in terms of their supply chain. It's always been a great relationship with Canada, as a supplier, particularly in the steel into the energy business and the large diameter pipeline. So a lot of people don't appreciate, the fact that the steel pipe making process involves making the plate steel and then converting that into large diameter pipeline. A lot of capacity here in the U.S. for smaller diameter steel products like is used in the drilling and in the production area. But when you get to large diameter pipeline, pretty limited capacity here in the U.S.
And I'm assuming capacity to be built would be quite difficult.
Right, and takes a while to gear that up, and a lot of those mills are already booked out pretty far. So, but the good news is, a lot of really good suppliers in Europe that we've always used as Williams.
Well, those tariffs are coming, though, I'm sure.
Yeah, so we'll see. I mean, I think. The
but
administration.
Are you currently laying pipe right now in the ground where this would be an immediate issue, or
we've already? I mean, anywhere we've got a project like that, we've already bought the steel well in advance, and we line those up well in advance. So it's not a situation where we've got pipe coming across the border and we're going to have to figure out how the tariffs work. So most of our pipe gets bought. We contract the business. Once it's contracted, then we go buy the pipe. And so the kind of ironic thing about that is because our permitting processes take so long here in the U.S. that we have plenty of time, unfortunately, to go buy the pipe while we're working on the permitting.
So the theme here, the administration, originally it was sort of drill baby drill, but the theme here among CEOs is build baby build, which is 100% up your alley and in your business.
Right.
What are the biggest hurdles? Like, is it permitting? Is it going to be sourcing? Is it labor?
Yeah, no, it is first and foremost permitting in the markets that we serve. We serve some of the more heavily populated areas like Seattle, Portland markets, New York, New Jersey, provide supplies up into New England and all along the eastern seaboard. So areas that have a lot of data center load right now going on, and as well as some big projects here in the Gulf Coast area serving LNG markets. So we've got a 42-inch pipeline right now that is being built from the Haynesville down into the tying into our Transco system, large diameter pipeline. So we've got a lot of big projects going on, but truly, when you get into the Northeast, the state's ability to block pipelines has been pretty chronic, particularly in the New York City into New York City, like, Governor Cuomo blocked 2 of our big pipelines. The outcome of that is $98 natural gas in the winter this year into New York City, which is going to
Can the federal government fix that if that's a state issue?
If the federal government, I would say that I think what's going to fix that is people being really upset about their utility bills.
Yeah.
And you saw
Summer can be tough.
Yeah. So you saw a couple of weeks ago where Governor Hochul actually went out in support of the Iroquois pipeline expansion into Long Island. And she recognized that it was because customers on the Con Ed system, while they were providing low-income assistance for people's utility bills, that was being completely eaten up by the fact that the cost of gas into those markets is high. And it's not because natural gas is high. Natural gas is so much cheaper than crude oil or fuel oil that's used for heating there. But it's just the fact that there's a bottleneck on infrastructure.
And then you add on to the fact that AI data demand need for power is going to increase a lot. You recently struck an agreement with an undisclosed investment-grade company to provide natural gas and power infrastructure. It's a 10-year purchase power agreement. The total cost of the project is about $1.6 billion. Can you tell us anything about who that customer is?
No, we cannot.
Okay.
So, and the good news is we have a customer that really wants to make sure we get all the permitting done, that we work closely with the local authorities to get permitting done there. So we very much respect that, as much as we'd like to talk about who that is.
Are you in other conversations with other companies to do something similar?
Yeah, yes.
How far along are those conversations?
I would say they're pretty advanced, and one thing we've learned is that speed to market is so critical right now. And what we learned in this last process was actually that these companies don't really want to have to go to the gas company to buy their supply and to the power generator to build the generation and then to manage that. I just want somebody to show up with the power and provide the gas supply to provide that power. And that's obviously something that Williams is really well positioned to do.
Well, talk about that, because I think of you guys as like a pipe thing that moves liquids.
Yeah.
Like, what do you have to do with power?
Yeah. So if you think about today, most of the natural gas now in the U.S. is produced, most of the power generation in the U.S. today is coming off the backs of natural gas. We've been in and out of the generation business for years. But what people probably don't appreciate is those same gas-fired generators that are used to compress the gas and move the gas on our pipelines are exactly the same piece of equipment that's used to spin the generator to provide power. So we're one of the largest buyers for Solar turbines, which is a Caterpillar arm, and so we have a great relationship with Caterpillar through that. So we're able to get access to these very in-demand power generation facilities because of our relationship there.
So when you came to this deal and the conversations that you're also in, what's it like to come to pricing? How hard is it?
The main issues, well, I would say, we were very transparent about what our pricing expectations were. The main issue at the negotiating table was speed and reliability.
Okay, so they're willing to pay a premium or just pay up for
I wouldn't say
that?
it's a premium. I would say it was better than they could get off the grid, and certainly from a timing standpoint, a lot better than they could get off the grid. And so the grid in some of these areas is so, one of the areas that we serve a lot is the PJM market.
The Northeast,
And it takes, people are getting told it's going to be 8 years before they can get an interconnection, get somebody to study the interconnection for some of these large loads. So the market just has no appetite for tangling with that kind of bureaucracy, and that's why we're going to see more of this kind of behind the meter. People use this term behind the meter like everybody would understand what that means. It simply means that these people are buying their own generation facilities and they're not being connected into the grid.
Well, funnily enough, my next question was about behind-the-meter projects. So what's your willingness to increase CapEx if those kind of projects go through, or those, you have a potential 30 behind-the-meter projects that could come through? What's your CapEx tolerance?
Yeah, I mean, we have a lot of capacity right now. The good news is that our gas pipeline business and our gathering business has been producing very high returns for us, so a lot of incremental cash flow. So we have a lot of capital, a lot of financial capacity right now to invest in this space. Obviously, it's going to have to be, secured with strong credits for us to take that on. But we've got quite a bit of capacity right now. It'd be 6 months ago, our investors were asking us, what are you guys going to do with all this cash flow? Cash flow is piling up on you. What are you going to do with it all? So this is actually kind of a nice place for us to be able to go, a nice investment for us to be able to go to.
So you do have a CapEx cycle going there. There's also potential M&A opportunities. There's been a lot of action in this space, particularly as it surrounds power. What would you be in the market for?
We've been very successful at doing setting our strategy each year with our board, and so we kind of predetermine, hey, here's the stuff we want to go after. For instance, last year and the year before that, it was going after the storage business because we knew with both LNG loads and with intermittent power loads that the amount of storage, the demand for storage was going to go up. We've seen the demand for gas over the last 10 years go up by 47%. And storage only went up by 2%. So new storage capacity only went up by 2%. So we kind of sit back, study, and get real conviction at the board level on this is what we're going to go after. Until we see the signals change, we're going to go after that. So we went out and we're the largest owner of storage now in the Gulf Coast area.
So now what's the theme?
And so now we are in the process of continuing to do bolt-on transactions, particularly in areas where we think there's going to be a new call on gas. I mean, you talk about all this demand side, investment. Well, there's going to have to be a lot of supply side investment in the gathering areas to be able to keep up with all this demand. And so that's the kind of the next area we're looking at is where's all this gas going to come from and how do we position ourselves to be able to take advantage of that.
Is volatility and uncertainty good for helping make those decisions?
No.
Okay.
No, we have a gas trading arm that loves to see volatility, obviously, but no, in general, we like to see gas prices at a level that producers are making a decent return, and that it's low enough that it incents people making big capital investments, like LNG export facilities, like power generation facilities.
What's that price? What's that perfect price?
It depends on where we are in the inflation cycle, but right now we think kind of the high threes is a pretty good number, and a lot of producers are saying no, it's $4.50, it's $5. Well, we're seeing pretty good response right now from the producing community at these kind of prices. So, but we definitely have got to get after it because there is a lot of incremental demand coming on between LNG and the power generation. And at least for the time period, it's going to be pretty sticky demand. It's going to be some pretty heavy loads on the system. And so, in January of this year, this is an amazing stat to me. We get so much attention from our investors on, oh my gosh, you guys got a data center project. That is so cool.
Yeah.
Well, it's not that big a load, frankly. I mean, it's a nice load and it's a nice return. And hopefully the first of many to come. But what we did announce at our earnings call this year was in January of this year, on Transco alone, we saw a 10% increase over the highest January we'd ever seen on our system. And it wasn't cold weather. This is on top of the January of 22 when we had a blizzard that hit the Northeast. And that really peaked the demand. So a 10% increase for the entire month in terms of volumes on our system. And this winter alone, we have seen 18 now of the top 20 peak days ever on our systems. All the weather cycles we've ever seen, 18 of the top 20 peak days. So the demands on our system are really picking up. If I was an investor, I'd be wanting to know more about that, frankly. So
I'm sure. And that's more business opportunity for you and not just data center demand. Really appreciate it, Alan. Thanks very much. Alan Armstrong, Williams CEO, joining us there. Paul, back to you.
All right, Alix Steele, thank you so much. We appreciate that. That's Bloomberg Intelligence co-host Alix Steele speaking with Williams Company CEO Alan Armstrong down at CERAWEEK down in Houston, Texas.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.